Hi there everybody and welcome back to another stock analysis video. Today we are now going to be analyzing the company Whirlpool, a company that makes a lot of appliances for your house. I believe they make refrigerators, they make stoves, I think they also make washers and dryers and all that stuff. So it's a company that is definitely needed, I guess you could say, because every single home definitely needs a refrigerator and a stove and a dryer and washer and all this stuff. So when it comes to a moat, this company might be actually very, very good. And seeing that their earnings are actually coming out after close on Monday, we are going to see this company's fundamentals and try to come up with a good target share price for this company. So with that said, let's get started with this analysis. We are going to come right into the dividend summary. This company does pay a dividend yield of 4.03%, which ends up being, guys, $1.75 per share, which is actually really high. Annual dividends come out to be around $7, with a payout ratio in regards to the net income of 20.44, which is actually really good too. Now, in regards to the cash flow, we're going to see in just a little bit, but this is pretty much just telling me that the cash flow one may actually be significantly good too. The 5-year growth rate on this dividend is on the single digits at 8.27%. However, 8.27% is nothing to scoff about because it's still pretty high. And actually, seeing that they have grown this dividend for 9 consecutive years is pretty much just telling me that they might continue it to grow into the future, especially if they have a lot of cash flow still left after paying out this dividend. Ex-dividend date is actually going to be as of May 19th, so we still have a little bit of time, almost a month, to buy this company and still be in line with their ex-dividend date. Payout date is on June 15th, and they pay their dividends quarterly. Coming over here now to the calculator, we got the ticker symbol of WHR for Whirlpool, market cap of $10.2 billion, PE, guys, of 6.18. So with the current share price of $173.82, this actually might be a fairly good price company according to their earnings. Now, $173 is a lot. We're going to see exactly what we would like to pay for this company because in accordance to the earnings, this is a pretty good buy. However, we need to take a look at other metrics such as shares outstanding, future shares outstanding, free cash flow into the future, and all this stuff to come up with an even more accurate representation. Now, with the $7 in dividends that they pay annually per share, this comes out to be, guys, $413 million being paid out in dividends every single year. In regards to their 5-year average free cash flow, after this is paid out, they're still left with $518.6 million, which is a payout ratio in regards to the free cash flow of 44.33%. So it's a little bit higher than that of the payout ratio in regards to the net income. However, at 44.33%, they are still significantly under my margin of safety of 60%. Now let's come over here to the fundamentals, starting of course with the net income 5 years ago of $350 million to 1 year ago of $1.8 billion, increase of a whopping 409%. Now obviously the big elephant in the room here is that 4 years ago they went negative in their net income of $183 million. Now what caused this? I have no idea. If this was 2 years ago, then maybe you could say COVID, but here you have right here COVID year at $1.1 billion. Now, even though I can't really explain the 4 year ago, I could definitely explain this 1 year ago mark. And that is the fact that a lot of people were buying houses like to no end because the interest rates were just so low. And the more houses that people buy at such a low interest rate, because people were just flooded with money because the government just kept giving people money for free, even though it's not really free, people decided to buy more appliances, right? People maybe decided to upgrade their house if they already had one. So they decided to upgrade their kitchen, get new appliances, all that stuff, right? So this is probably explaining why this jump from $1.1 billion to $1.8 billion. Now, will this continue? I don't necessarily know. Interest rates are going up, things are getting tighter, the economy is getting worse, inflation is going up, things are getting more expensive. So in the future, I actually might foresee this number to actually come down, but as it stands, it's still a massive increase within the past 5 years. Now looking at the free cash flow, cash from operations less your capital expenditures. 5 years ago of $580 million to look at this, 1 year ago of almost $1.7 billion. There's an increase of 185%, an average rate of $931.6 million. Now this graph actually looks fairly steady. Now it was somewhat flat from 4 years ago to 3 years ago, right? 639 million to 698 million, essentially 700. It's essentially pretty flat within these 3 years, 5, 4, and 3. However, 2 years ago, 1.1, and then 1 year ago, again, makes sense. People were buying appliances, people were buying houses. It was shot up to $1.7 billion. As it stands, very, very good. However, gonna have to take a look at this into the future because it's a little bit more difficult to predict things now that interest rates are going up. Coming over here now to the revenue. 5 years ago of $21.3 billion to 1 year ago of $22 billion. Now that's an increase, guys, of 3.44%, which is actually really, really surprising. The other two metrics were going up, yet the revenue was actually, well, remaining somewhat the same. I mean, it was a slight increase, sure, but if you just take a look at from 4 to 3 to 2 years ago, it went down and then it shot back up. So I don't necessarily know if this is a good thing. I mean, it is still an increase, don't get me wrong. However, you want it to be consistently growing up. And I would have to imagine that a company that makes appliances, right? Unless somebody's refrigerator or stove or washer breaks, you are probably not going to buy a new appliance, especially if the economy is doing really, really bad and things are getting way more expensive as time passes. So this actually kind of does make sense, and I do foresee maybe this number even going down into the next 4 years as well. Looking at the total assets minus the total liabilities now, this one tells you whether or not the company's assets would cover their entire liabilities. And as we can see right here, currently they are at $1.2 billion in assets minus liabilities. Now, something to definitely take note is that 5 years ago, 4 years ago, and 3 years ago, they were in the red by several negative million dollars, and then 4 years ago they were down to $1.8 billion, again in the negative. So as it stands, it's really, really bad that, you know, they've actually not been able to keep their assets and liabilities in the positive. And seeing that 4 years ago they did negative $1.8 billion, it's going to skew all these numbers down, which we can actually see right here in their total average assets of $1.6 billion. Average total liabilities is $8.6 billion, and average assets minus the average liabilities, we get negative $26.2 million. Now looking at the shares outstanding, a metric that tells you whether or not the company is diluting you as the investor. You want this number to be coming down. And when I saw this, I did not believe the numbers. I just gotta be completely honest, I did not believe the numbers because, well, this is a massive, massive decrease when it comes to their shares outstanding. 5 years ago of 70.6 million shares to today, guys, of 59 million shares. On the 5 year, that is a decrease of negative 16.43%, so almost 16.5%. And from the previous year to the current year, we are looking at 2 years ago to 1 year ago. This is at 63 million shares to 59 million shares. That is a decrease of 6.35%. Again, massive, massive decrease in just 1 year. And well, this actually might give an insight as to where the rest of their cash flow is going. So looking back at the assets and liabilities, they could obviously just switch their view into, instead of buying back shares, maybe they could put it back into paying off their debts. So as it stands, seeing their assets and liabilities this bad, it may not be as bad because we know where the rest of their cash flow is going. And lastly, guys, looking at the cash equivalents, they currently have around $3 billion in cash equivalents with an average cash equivalents of $2.3 billion. Now let's come over here and of course make some assumptions, low, medium, high, using 3 different factors: growth assumption, projected share buyback, and the required rate of return. Guys, for the growth assumption, I'm going to be using Seeking Alpha's growth tab, as always, between the revenue growth year over year and the revenue growth forward. For the projected share buyback, I'm going to be using the shares outstanding that we just saw. And for the required rate of return, I'm going to keep it the same at 10% across all assumptions. Now, for my lowest assumption, I'm going to assume a growth of 9%, predicted share buyback of 2% within the next 4 years. This comes out to be $36.77. For my media assumption, let's assume a growth of 12% and a projected share buyback of 3%. This comes out to be $41.02. And lastly, for my highest assumption, I'm going to assume a growth of 15%, predicted share buyback of 4%. This comes out to be $45.68. Now adjusting for debt, the way we do this is we take the cash equivalents and we add the net debt. If a company has more debt than cash, this number comes down. If a company has more cash than debt, this number comes up. And as you can see, it does come down a little bit to $34.71 for my lowest assumption, $38.95 for the median assumption, and $43.58 for my highest assumption. Now, I like to add a margin of safety just because I don't want to overpay for something. The more you pay for something today, the less returns you're going to have in the future. So, adding a margin of safety of 5, 10, and 15%, I would personally like to buy this between $29.50 all the way up to almost $33 for my low assumption. For my median assumption, it is between $33.10 to $37, and for my highest assumption, $37 all the way up to $41.40. Now, as it stands, guys, the current share price is $173.82. Now, most of you guys are probably saying that is ridiculous. This needs to drop more than $100 in order for you to buy it. Okay, understand how discounted free cash flow calculators work. You are projecting the cash flow into the future and then discounting it back to today. As it stands, guys, we just saw this, right? Their cash flow is not a lot, right? They recently just broke the $1 billion 2 years ago in regards to the free cash flow. And seeing that things are going to get significantly harder when it comes to inflation and all this stuff, I honestly foresee that this company shouldn't be worth more than around maybe like $60 or so. Maybe these numbers are a little bit skewed to be a little bit more conservative. However, it's better to be more conservative than not. So just because I am getting $45.68 for my highest assumption, not adjusting for debt, that doesn't necessarily mean that you won't be getting the same. Now, I have this calculator, guys, available for free. Anybody can have it. I also have my book value calculator as well and a dividend tracking sheet. I have videos on how to use all of these ones as well in my playlist called Calculators. So you go in there, there's videos on how to use them, where to find all the numbers, etc, etc, etc. And you guys can put in your own assumptions, right? Let's just say that you don't believe 15% is a good growth assumption for Whirlpool. Well, let's just say that you believe it's going to grow at 25% and that you think that they're going to do 60% share buyback within the next 4 years as well. So let's put 16, and right then and there, well, we get a target share price of $70.48. So as you can see, just changing all of these numbers around really does alter the target share prices that you will get. Again, these are just my assumptions. I'm teaching you guys a process. I'm not telling you guys to buy this at these share prices, or I'm not even telling you guys to buy this company. I'm just saying, based on the analysis that we just did, this is where essentially I would put this company at to buy it. I would find it at fair value. Now, all I'm asking for in return, guys, is for these calculators, like, subscribe, comment. It really does help here with the algorithm, of course, on YouTube. Thank you so much for all the subscriptions. And all I'm asking for in return, guys, for having these two calculators and the dividend tracking sheet is, of course, like, subscribe, comment. Help me grow. I really am trying my best. I'm going to put out so many videos out this week because there's just so many companies that are having earnings that I know people would just want to see how to use this calculator, or at least what I would price them at. So that's really all I wanted to say. These 3 free things for just a like, subscribe, comment, 30 seconds of your time is all I'm asking for. Now let's take a look at this company when it comes to their dividends, right? Because this is a huge dividend play. And as we can see right here, if we take the average US income at $68,703, bring it to the monthly, we take $5,725. Now, how many dividends of this company you would actually get if you were to invest 1 month's income at this average US income? Well, at the current annual dividends per share, this would buy you around almost 33 shares, which would be an annual dividends of $230.56, which would be the same as $57.64 every single quarter and $19.21 essentially every single month. So as it stands, guys, this is actually looking very good. Companies that have a $7 dividend are really hard to come by. Now, when it comes to their fundamentals, that's a different story, right? You don't just want to buy a company for their dividend, you want to have the diamond in all the coal mine. You want to have a company that has amazing fundamentals, that is also very fairly priced or underpriced, and that pays a massive dividend. That's essentially the perfect company that you want to buy. As it stands, I don't necessarily know what you guys would put the target share prices for this company at. However, for me, yeah, their fundamentals look pretty good. However, they might be a little bit overvalued, at least for me. So this $7 dividend is amazing, don't get me wrong, but it would be even better if the company's share price were to fall down a little bit more. All in all, guys, when it comes to Whirlpool, Honestly, it's a company that has a pretty good moat. However, in regards to how much necessity I guess they will need within the next years, I don't necessarily know where you would put this at because, again, inflation is getting worse. People will probably not be renovating their kitchens or their houses, or honestly, people might just stop buying houses if interest rates keep going up, right? Eventually, there will be a breaking point. So, as it stands, I don't necessarily know where you would put this company at. But this is just my analysis. And that pretty much does it for this video. Liked if you like, comment, subscribe. As I said, thank you so much for watching. You guys can follow me on my new tech sites at BitChute, Odyssey, and Rumble. All links in the description. I have a Let's Play channel as well. Link in the description below. So if you want to follow me, you can follow me there. Now, before I go, I would just like to say something that is actually really, really important. And I would just like to say I messed up. And I realized that there was actually an incorrect formula in the discounted free cash flow calculator. So I have updated it in the discounted free cash flow calculator sheet that's available for all of you guys. So just letting you all know that the new one is updated, and if you have the old one, then I highly suggest you get the new one because the old one had a wrong formula. So again, I'm really, really sorry for that. It really does hurt because a lot of you guys have had this for a while, and it really just sucks that I made a stupid mistake. So yeah, it should be fixed now. And again, I'm really, really sorry, but it's updated. Just re-download it again. Everything should remain the same. Thank you very much for watching, and I will see you all in the next stock analysis of video.